Fidelity is cutting out Goldman Sachs as a middleman when it comes to dealing with Wall Street short sellers. The money manager is bringing its stock lending business in-house. With the latest, let's bring in Bloomberg's Weiss, who wrote the story. Miles, it's a fascinating story. Fidelity saving 10% on these transactions, and obviously the curiosity here is whether this is just a cost-saving move, or is there something informationally that benefits Fidelity by doing this as well?
Oh, hi, Vonnie. It could help increase the returns at the various Fidelity funds that lend out securities, or it could help boost revenue for Fidelity itself. It kind of depends what they decide to do with the savings. There are a couple other advantages as well. There is an informational advantage. It'll let the funds work more closely with the broker-dealer that's representing them, since it's an in-house broker as opposed to Goldman.
Miles, the question has to be, considering that BlackRock and Vanguard already do this, why has it taken them so long?
That's a good question. It may have been simply that they're using some third-party software, and it may have been that the software and their lending desk is up to the point now where they think they can handle this internally instead of using Goldman.
So, Miles, what kind of numbers are we talking about here? What tend to be total loans, for example, in any particular year? Do we have access to that information?
Yeah, it is in there. It is in the regulatory reports for each fund. The SEC limits the amount that funds can lend, the amount of securities that funds can lend out. I think it's about a third of their securities. The Fidelity funds, it kind of varies. Some like the small cap funds, the ones that have stocks that are really in demand by borrowers or short sellers, they tend to have a higher percentage lent out, maybe up around 13, 14, 15%.
Okay, Miles, can I just circle back to what you said just a moment about it kind of depends on what they do with the money. Like some of the other funds, as I mentioned, BlackRock, Vanguard, they give the money back to shareholders. But the fight at the moment on fees is absolutely cutthroat. Is there a story developing here where you think the money is not going to go back to shareholders? If Fidelity decides to push this into fees, the others are going to have to follow, and that's going to have implications for shareholders in these big companies.
Well, Vanguard already gives back quite a bit of. Vanguard gives back about 98% of the securities lending revenue to its funds. Fidelity will give back at least 90.1%, and they could decide to give back even more than that. But even if you're keeping the revenue, you can do other things that might enable you to lower your to lower the management fee in the index fund even more. So it can be a little bit deceptive to say, well, to just look at the percentage that they're returning to fund holders. Sometimes that allows them to have a higher management fee than they would otherwise.